Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So now, this is kind of my favorite part, and I think this is where Forex gets, FX gets a lot more exciting, okay? And that is in the inter-month spreads, all right? One of the things that you'll see is a lot of people make the mistake of thinking implied volatility is low, so they should do what? If you listen to half of the gurus out there, when vol's low, what do they tell you to go out and do?
I would assume they say to buy, I don't know.
Calendars. They say buy calendars, which yes and no, all right? When vol is low, calendars can work. I've actually found that calendars can work just as well when vols are super high and when vols are normal priced. The thing about it is that the months do not move uniformly, all right? Each month, in many ways, is its own product, okay? For instance, all right, it is currently September 17th, right? No, it's September 21st. Sorry. It's September 21st, all right? How many days are there till October expiration? There's, how many days are there, actually? Is that sad? But I can't think of that off the top of my head.
Yeah, I don't know it either, but...
There are 25 days to October expiration. All right? All right, let's see where we ended up today, just for giggles here. All right.
Those are calendar days, correct?
Yeah. 25 calendar days. All right? Now, which contract month do you think is more correlated? All right? Which two contract months? October and November, or November and June 2011? All right? Which two contract months are more correlated? October and November, or November and June 2011?
You would guess that there would be the shorter term ones that are very close in time.
Yeah. I'm seeing Ocnov. The first one to get the right answer, next time you're in Chicago, I'll buy you a Mai Tai at Trader Vic's.
Nice.
By the way, if you're ever trading on the floor and you decide that you need an alternative investment relative to stocks, restaurants are not a good alternative investment. We got, I saw Ocnov. Any other guesses here? All right. Many would think it's October and November. The facts of the matter are, I would consider November and June 2011 to be far more similar in the way that they move and the way that they operate than October and November. Okay? And this is why you can't just trade calendars when they're low or trade calendars in the high. I like to think about October, the front month and the next month out as kind of two brothers, all right? One is the older, quieter, let's use another one, all right? They're a truck and a car, let's say a Maserati, all right? And you've got a truck, let's say a Peterbilt truck, and a Maserati in a two-lane highway at a stoplight, okay? And the light goes green, and they immediately slam on the gas, all right? They slam on the gas until they reach, they're going to slam on the gas until they each reach 80 miles an hour, all right? Which one is going to get to 80 miles an hour first? The Maserati or the Peterbilt truck? The answer is obviously the Maserati. Now, if you ask them to brake, once they both get up to 100 miles an hour, which one is going to slow down faster, the Maserati or the truck? The Maserati, right. The Maserati, right. The Maserati, I think of the Maserati as front month options and the truck as back month options. Back month options are going to be slower to gain vol, but once they do, look out, and they're also going to be slower to lose their volatility. And once they do, look out, okay? The front month options can swing back and forth, up and down, at an unbelievable rate, okay? So, with that, all right, let's take a look at, despite the fact that these months actually do move separately, there is a correlation. And over time, a typical or normal spread kind of does develop. You know, when I was in the SPX, at the time, we did not have contango. We had contango is when back months have higher volatilities than front months. If you're interested in that, go read Bill Luby's blog. But so what we had was a case where we knew that the front month was going to be about a point over the next month out, and that was going to be about a half a point over the next month out, and so on and so on and so on. And you'll see kind of this normal spread develop over time. And then based on this kind of normalcy that you'll see, there are ways to take advantage. All right, so here is a chart from LiveVol Pro, all right, of YUK, which is Japanese, the yen. Right? It's the yen converted into dollars, right? It's the yen-dollar conversion, all right? So you can see, what do we normally see here under normal circumstances, all right? The red IV is volatility 30 days out, okay? The yellow line is implied volatility 60 days out. What do we see? Well, what we see is that under normal circumstances, okay, that back month is going to be higher than the front, have a higher implied volatility than the front month. But yeah, I mean, I'm not familiar with that term. Someone saying, I thought contango spot price is cheaper than the market price. That, you know, that is in terms of how oil works, maybe. The contango I'm talking about is kind of VIX term structure and volatility term structure. I think it's same word, two similar meanings. And if you think about what you just wrote, it's actually very similar, right, to what I was just saying. Somebody wrote, yeah. So somebody was saying they thought contango was spot price cheaper than market price, such as investment banks buy Park Oil and tankers, right? And vol, it can be very similar. In many ways, volatility is a commodity. There's something that has a commodity skew. If you want to see a commodity skew, little tangent here is pull up VIX options. I know I'm not supposed to show VIX options because I'm on the ice, right?
That's all right.
I'm sorry. So you know, that's a classic commodity skew. There's always fear of volatility going up, not going down.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.